folks. Welcome to the REIT Leadership Series webinar for Wednesday, September 23rd. I'm Sam Chandan, the Silverstein Chair and Dean of the Schack Institute at NYU. I'm delighted, as always, to be joined by my colleagues, Adam Emmerich, partner at Wachtell Lipton and co-chair with Robin Panovka of the REIT M&A practice at Wachtell. Robin, unfortunately, is not able to join us today, but he is normally here and will be back very soon. He sends his apologies. We should mention that both Robin and Adam serve on NYU's REIT Center board, and Robin is a member of the board of the Schack Institute as well. Speaking of the REIT Center board, my colleague and friend Scott Robinson is here with us as always. Scott is a professor at NYU and the director of the NYU REIT Center. A couple of quick points. As always, thanks to Monmouth that sponsored the summer REIT series. We're truly grateful for that. The summer funding they provided helped us to offset some of the costs for students whose families had been impacted by the pandemic, so that they were able to continue with coursework over the summer. So we deeply appreciate that. Monmouth is a big supporter of Schack throughout the academic year, and this summer was especially impactful. It has been an amazing series, as I always mentioned. We kicked off on July 8th with Sam Zell. Since then, we've just had an absolute all-star lineup. Hamid Moghadam from Prologis, Debbie Cafaro, Sherry Rexroad, Hap Stein, Leslie Hale, you name it. We've been blown away by the success of the program. Between live attendees and replays, we've now had more than 20,000 people participate in the REIT Leadership Series, which has just been fantastic. And so we made the decision a couple of weeks ago that we're actually going to continue the series through the fall semester. What I'll mention in a moment, or in a few moments, I'll post some links into the chat feature. We are continuing with the series, but beginning next week, we are moving from Wednesdays at 12:30 Eastern Time to Tuesdays, 12:30 Eastern Time. If you're not getting our emails with the list of CEOs and chairmen that are speaking, please do sign up for our mailing list, and I'll share that link again. But we move to Tuesdays at 12:30 beginning next week, and then we'll continue through the fall. We're also really excited that in parallel, we're introducing through the CREFC Center for Real Estate Finance. Folks may remember that the Commercial Real Estate Finance Council made a substantial gift to Schack earlier this year to support the creation of a new research center in real estate finance, but also to endow some very robust scholarships to support our diversity and inclusion initiatives at Schack. One of the first initiatives of the CREFC Center is a new capital markets leadership series. So in parallel with the REIT series, we're interviewing and speaking with a different CEO or chairman of a major real estate capital provider. That begins next week, October 1st, on Thursday. So every Tuesday, the REIT series, every Thursday, the capital market series. And we have, again, a spectacular lineup for the capital market series. I'll share the registration link. Please do join us. We're going to be looking at what's in store for the availability of apartment financing and the structure of the apartment financing market, covering everything from the outlook for apartment demand, the cost of capital, the structure of agency financing in the market, as well as new and emerging sources of capital. So please don't miss that next Thursday. Really delighted this week to be joined by Tim Naughton. Tim and AvalonBay have been huge supporters of the Schack Institute and the REIT symposium that we host every year. Folks will remember that this year was to have been our 25th anniversary of the REIT symposium, and we are truly grateful to Tim and all of the other leaders in the industry that take the time out of their schedules to join us in New York every year, for what is undoubtedly sort of one of the most impactful conferences and gatherings in the industry. We will have the 25th REIT Symposium as soon as circumstances allow. And we are looking forward to it very much. But in the meantime, we're really thrilled with how many people we've been able to reach through this program, and how we've been able to keep the conversation active. If you're interested in learning more about the REIT Center, getting involved in some of the research work of the REIT Center that we're doing in the United States, but also now expanding to really look at the emergence of the REIT sector in China, in India, in other parts of the world where REITs are a relatively new feature of the market, but where we believe they'll play an important role in helping to formalize the sector. Schack is coming in with our resources and our faculty background to help support policymakers and others in different parts of the world where the REIT sector really is sort of in its nascence. So please do get in touch with Scott or myself if you want to learn more. Final reminder, please use the Q&A feature. There's also an upvote feature that I'm about to activate. So if you see questions that you like, hit the like button. They'll rise in the order of priority. Scott and I are going to come back to join Tim and Adam at around 1:10, 1:15 Eastern time, and we'll pose the most popular questions to Tim. So we have a chance for some audience input. So enjoy the next hour. Thanks as always for joining us. We're really excited that you're here. For anyone who's observing the high holidays, Shana Tova, belatedly, and we will catch you again in about 40 minutes. Adam, take it away.
Sam, thanks so much. Scott, Tim, thank you so much for being with us today. It's really a pleasure. Sam gave you a bit of an introduction, and you really need no introduction. I'll just mention briefly, you've been CEO of AvalonBay since 2012, I think, and you've been with the company since 1989. We've actually had the privilege ourselves at Wachtell Lipton of having known the company for a long time, since the merger of Avalon and Bay, which we helped out with on the Avalon side, but I think your tenure is even longer. So your depth of knowledge of the company and the sector and the public REIT world is really unparalleled, and you have an unbelievable window into what's been going on during this pandemic era. Maybe we'll start out with that. I mean, obviously, multifamily sector. You're not everywhere in the country, and one thing we'll touch on in terms of where you are and what perspective that's lent to your operations. But everybody lives somewhere, and people have been making major decisions during the pandemic in terms of rent versus buy, where they're living. Can you just give us, to start off with, a kind of a sense of your perspective on what's been going on over the last 6 months, and how much of an impact it's had on AvalonBay and other participants in the sector?
Absolutely, Adam. And first of all, Adam, Sam, and Scott, thanks for having me and inviting me to join you for this conversation. And Adam's right. We've been working with Wachtell Lipton for a long time. I think the AvalonBay merger go back to 1998. So my tenure is maybe about 10 years longer than that. And pretty much I've always lived in the DC area. Maybe to start off, Adam, it would be helpful just to know what markets we are in. We're generally in the coastal expensive markets, Mid-Atlantic, Northeast, West Coast, Seattle down to San Diego. More recently, we've gotten into Denver and in Southeast Florida. So tends to be higher end, more expensive. We've built a lot of the portfolio. We're active developers. So I think that's important context in terms of what we've seen. We've seen a big drop off in demand, apartment demand in our markets. I think part of it is sort of the blue state focus was hit. Those markets were hit harder and have been slower to reopen their economies. And so it's more than just what you typically would see in a recession in terms of a drop off in jobs, of course, and household consolidation. But we've also seen sort of shifting demand where where people are moving back in with parents, which is typical in a recession. You see some of that. But what you're seeing that's different this time around, they are moving to less dense locations, whether that's the suburbs. Often case, we play in both the urban and the suburban infill, if you will. Moving to beach houses that their families might have. Maybe going back to sort of creating their own bubble with either friends or family in a second home. Some are moving to cheaper markets. We've seen that in San Jose and San Francisco in particular, where a lot of the tech companies have already said you're not going to have to come back till next summer. People have just gone to live in cheaper places, whether that's Austin or Las Vegas or Phoenix. And then lastly, I think we've seen some Airbnb nomads where people are just since they can work from anywhere, assuming they still have their job, they've been moving. They've been kind of moving around to different places. So I'd say that the conditions are quite soft right now, much softer in urban core submarkets than the suburbs. You're probably seeing a decline in the occupancies around 2.5% to 3%. That's a lot in our industry. We've seen rental rate declines on the order of sort of mid-single digits over the last 6 months on a net effective basis, including concessions. So we're not seeing any signs yet of recovery or bottoming. Obviously workers aren't really yet returning to the office. We were talking earlier about while our office is open, it's open on an optional basis. So we're seeing maybe 10% of the folks come in. So for the most part, people that have the choice to work from home are making that choice, or working from someplace other than home and the office. So that's a bit of what we're seeing on the ground right now.
Tim, in preparing to chat with you today, I looked over your quarterly earnings announcement, most recent one, and other stuff like that. And obviously, you know the facts, and what you just said is exactly what you said publicly about sort of the 2%. To me, as a layperson or an ignorant lawyer, I'm having trouble connecting the dots between kind of the massive migration, change in patterns of working, people going to the beach or Phoenix or wherever, and 2%.
Yeah.
2%, why is that so big?
No, it's a fair question. I think some people, well, first of all, there's a lot of, we turn over about 50% of the portfolio every year. So if we have 100,000 units, 50,000 of those units are turning over and becoming available back into the market. So what we tend to see historically, Adam, stability in the rental apartment business is around 95 to 96% occupancy. And that usually translates into inventory that's available today that's either not leased or been put on notice. It has been rented, but maybe 6 to 7%. When you increase that by 30 or 40%, which is kind of the math that we're talking about, that creates pretty soft market conditions. And given that you're constantly turning over and getting new inventory back from residents, you can fall behind pretty quickly. And so it creates a lot of pressure to respond with price and concessions and sort of reach down into the renter pool to fill the properties.
I mean, Yogi Berra said that predictions about the future are the hardest kind, or something like that.
Yeah.
Do you have any sense of, including because you're in different parts of the country that have been kind of experiencing this in different ways, any sense of, when the turn might come or what it might look like?
I personally think it's not going to happen until people start coming back to work, honestly. But typically at the portfolio level, it's when you start to see occupancies and the availability start to stabilize a bit. And normalize, because what we're doing, because we play at sort of the top end of the pyramid, we're reaching down, sort of further into the rental pool, and then, similarly, people that are sort of in the next layer of the pyramid are reaching down until occupancy sort of normalize across all product types and price points. You're going to have a pretty dynamic market. I think we're starting to kind of get to that point now where, assets, urban's different than suburban, but if you just take suburban markets, where assets are sort of all starting to converge into kind of a market occupancy. So that's kind of the first step that you look for. At the in terms of job growth, obviously we're just sort of filling the hole at this point. While the numbers have been pretty good, it's coming off of numbers that are probably 20% plus unemployment. Today the estimates are, the numbers that the government puts out are 8 or 9%, but the estimates are really closer to 14 or 15% when you think about the labor participation rate. So I think until people start coming back to work, you start creating some movement in the economy, we're really not even going to see the bottom. And I think we're still searching for the bottom. So if you look at past cycles, what you typically have seen in the apartment business, it's been about a 2-year correction in terms of pricing and rental rates, and then usually followed by a third year that's relatively flat, which means the market's improving, right? To actually experience flat rental really rent rate growth in the third, sort of late in the second or third year of the recovery. So we're, by all accounts, we're only 6 months into this, and
Yeah.
the last 2 cycles, we'd have about another, sort of year and a half to go before we really saw some stabilization.
Avalon has been a great developer. I mean, really, you have a culture and a style of doing it that's been super successful over the years. Are you cutting back now for a period of time, or what's your approach on that front?
Yeah, no, we get asked that question a lot. First of all, going into before the pandemic started, we were already bringing down our level of development as we got sort of later in the cycle. The opportunity set wasn't as attractive. REIT started to trade, at or below NAV. I'm going back 3 or 4 years now.
Yeah.
And so we were probably peak development starts in the 13 to 18 timeframe. So we were already bringing it down from about $1.5 billion a year to right around $1 billion a year. Since the pandemic started, we basically just put everything on pause. And that's for a couple of reasons. Obviously, we're going into recession. We didn't know there wasn't a lot of visibility, but also we've just gone through a 10-year expansion. In the last few years, we've seen pretty dramatic construction cost inflation. And based upon our experience in prior cycles, we're going to see some correction in construction costs. So we think the right thing to do is to wait until we see some correction. Subcontractor backlogs, aren't close to clearing. They're starting to whittle down a little bit. But until they see those backlogs really thin out a lot more, we're not going to see profit margins. We're not going to see, subcontractors developing a more productive business model so they can ultimately deliver at a much lower cost. We're in the very early innings of that. We're probably seeing cost stabilization and maybe small single-digit reductions in construction costs. But to put in perspective, we saw construction cost declines in 09 and 10, probably on the order of 20%, in some cases 25 to 30%. So until we see that kind of correction, we think it makes sense to kind of hit pause, and we'll start to gear up as we start to see markets come into more balance.
And are you seeing that kind of slowdown in new product coming into the markets, or anticipated slowdown as people put development on hold, kind of across the competitive landscape?
It's down, particularly starts, but we went into this downturn with fairly level starts. If you look at 2018, 2019, so we're going to see deliveries over the next couple of years that aren't dramatically different than what we saw a couple of years before that. I think as you get into 2022, 2023, you're going to see a pretty big drop in deliveries, because new starts will be coming down. I'm confident that over the next few quarters. And in our markets, we've already started to see starts come down by, call it 20 to 30%, depending upon what market you're in. Some markets it's flat, some markets it's actually up a little bit, some markets it's down dramatically.
And what accounts for that variation? Is there some underlying landscape that makes sense in terms of how to make sense of that?
Yeah, it's not as attractive economically, for one, because of our construction costs. Construction lenders are definitely much more disciplined right now. Some have redlined. A lot of the big money center banks have just redlined construction financing for multifamily right now. It tends to be more the regionals, some of the international banks that have been more active on the construction. So I would say just less capital from the obvious sources that put a bit of constraint, and combined with just the opportunity set just hasn't been as attractive as it was the prior years. When you're 10 years into expansion,
right,
a lot of the good assets, a lot of good opportunities have sort of been picked over, and costs of construction costs have been going up mid to high single digit for the last few years. And you start getting, which is much stronger than what rents are. So yields and projected returns have come down, and in many cases just aren't meeting the thresholds that they were early to mid cycle.
Do you think that these kind of seismic things that we're going through right now will result in whether public competitors or private competitors engaging in a bunch of M&A activity or portfolio transactions, or do you think it will it's not conducive to that sort of activity.
Well, if you're talking about the multifamily space,
Yeah, in the multifamily
I
space.
don't think we're going to see a lot of public to public. It's pretty well consolidated, as you know. It's a sector that's probably acted the most rationally in terms of consolidation over the last 20 years. When we went public out, I think within a couple of years of us going public, there were 35 multifamily REITs, and
Right.
today there's basically 7 that are above called $1 billion or $1.5 billion in market cap. So we've already seen about 80% consolidation. A lot of it was public to private, but a fair bit of it was public to public as well. You mentioned the AvalonBay merger before. REITs are trading at, we'll probably talk about this in a minute, REITs are trading at a pretty big discount to NAV. So, I don't think you're going to see a lot of private to public consolidation. And so it raises the question whether you might see some public to private based upon the NAV discounts. There's just not that many companies that are that make sense, that are even available for that. But I think in time maybe we'll get into this later, but some of the technology investments and service innovation that's going on in the sector, I think that could lead over time to some consolidation, private to public. I don't think now is the right time, just based upon where public companies are trading at, but I think there is an advantage, whether it's private or public, companies of scale, large platforms that are investing in technology and service innovation are gonna have stronger margins than kind of the smaller players in the market. And I think that's going to create some opportunities, whether it's one-off acquisitions or portfolio transactions. We'll see.
Maybe talk for a sec, because you touched on it, in terms of the impact of technology and changing patterns. I know you've really been a leader in investing in technology and services for residents in a changing world of shopping from home and maybe now working from home. If you could talk for a minute about what you've done over the last couple of years and how you see the next few years evolving and how that's changed as a result of the pandemic and demand for multifamily product.
Yeah, no, it's a good question. And even before COVID, there was already a movement. I think within the larger both private and public platforms to be investing in digitization, trying to create the more contactless or touchless interaction with our customers, really leveraging technology, using technology as an enabler. And it really touches almost every contact point that you have with customers, whether it's setting appointments, identifying the initial prospect, whether it's setting tours. During the pandemic, we and everyone else figured out how to do tours virtually pretty well. Whether it's leasing, signing an application, or signing a lease, scheduling a move-in. I think the technology is there. It still needs to be developed, but the base technology is there to basically create applications that can make all that contactless, where you never have to talk or meet with anybody in the office or on the site in order to basically the 10 or 12 major points of contact you have with the office today, or you've had over the last 10 years, those are all going to get digitized for the most part. So I think the pandemic is certainly, I think it's accelerated our view that we can do that maybe more quickly. Mm-hmm. And we may have roadmapped beforehand. We joke about a little bit internally that, if I were to, before the pandemic, if I were to ask how long it's going to take to be able to put everybody online, virtually, so that everyone can work from home, the entire overhead structure of the organization, which is several hundred people. Yeah. And by the way, we also have to figure out a way to tour prospects and lease apartments without ever seeing anybody or physically touring or meeting them. I suspect that would have been a one-year work plan, and yet we figured out how to do it in a week or two. And we're not the only ones. Others have been able to do. So I think it's given management teams like us more confidence that we can move more quickly in the area of applying technology to really sort of transform the way we interact with customers. And there's real efficiencies there in terms of cost savings and margin expansion opportunities for companies or small groups, small organizations only have a small portfolio. They're probably not going to invest in these technologies or the infrastructure you have to have on in the organization in order to support them. And so that's where I think there could be a opportunity for more consolidation in the industry. And REITs only own 15 or 20% of the institutional quality product today. I think there's a really good opportunity, whether it's us or large private equity platforms that go quite a bit more.
For Avalon and other public REITs, you think it's effectively, it requires an absence of an NAV discount as a practical matter in terms of funding and assimilating those kind of portfolios?
You'd like to think over time you trade around NAV or a bit better than NAV, so you'd have the opportunity to grow the balance sheet. We do have free cash flow. We do have, when it's not a recession, we do have growing free cash flow, the growing ability to issue more debt. So we can't typically grow without raising equity, but not, you really need the equity market to be there to grow in any material ways, as you know.
Yeah. Let me just shift gears for a sec, Tim. You're obviously interacting as an enterprise with government on many different levels, whether it's eviction moratoriums in some of your markets, whether it's the Fed's cheap money response to the pandemic. Can you talk a little bit about your experience, and particularly as it varies by region in terms of the governmental response to the pandemic and how it's impacted you and what you've learned from it?
I'll try. So in terms of the federal response, obviously, we and others have benefited from the stimulus. Just putting money in our residents' pockets who have been directly impacted by the pandemic. So that's been a net benefit for the industry for sure. I think the big concern is these eviction moratoria. We understand sort of the idea of it and trying to lessen the pain, but it is the government intervening in a private contract between a landlord and a tenant, and there is a threat of moral hazard, much like we saw in the global financial crisis, and the notion of potentially forgiving underwater debt. So to date, it hasn't been that severe. We've seen, and all the public REITs have disclosed this. I think we're all seeing on the order of maybe a couple % of our residents that we kind of refer to as kind of the ghost renters, that they're not responding, they're not paying rent, we're offering payment, different payment terms, payment plans to all of them, and we just can't even have a conversation with them because of the eviction moratoria. And those, there's federal moratoria, there's state and local moratoria. The state and local moratoria probably been more severe in our markets, just kind of given the blue state footprint. But we literally have probably 60 different sets of regulations we're managing across a portfolio of called 270, 300 apartment communities. So it's a real quagmire to sort of work through in terms of what your rights are as a landlord to either force a conversation with a resident, or ultimately try to get the real estate back if you have somebody that is really just a bad actor and is strategically defaulting, if you will.
I mean, obviously, there's a bigger overlay in terms of the whole political situation in our country, and I don't think we should get into that too deeply. But in terms of over a longer term, and particularly given where your footprint is, given all the concerns we have in society about income inequality and other things along those lines, do you see major changes in the regulatory environment or in the operating environment for your properties?
I think there's a threat of that for sure, and maybe it's been accelerated by what's going on right now in terms of governance intervening in the case of eviction moratoria. There's a lot of even before the pandemic, there was a lot of chatter and action being taken around rent control, particularly in some of our markets, whether it's New York, California. A lot of people on this call are probably familiar with Prop 21, which basically would repeal a law that's already in the books that sort of precludes you from having rent control in most properties in California. That could potentially be repealed and allow local jurisdictions to impose rent control, which we're fighting vigorously along with a lot of other apartment companies, because ultimately the result's going to be is what we know. It may be politically expedient, but ultimately we're going to end up with less housing under any kind of rent control regime. So I do have a concern when you just sort of step back and you look at what's happening in the economy. It's a knowledge-based economy. It's being driven by knowledge-based industries. Those industries are much more capital efficient than a manufacturing economy or what we're accustomed to, I think, in our world. And so it's more capital efficient in terms of the financial resource required, and then also the human capital resources. So if you just compare, say, Facebook to a REIT, Facebook probably capitalized itself with a $10-20 million. It's a $500 billion company. We capitalize ourselves with $500 million, and a few years later, it's maybe worth $1 billion. And it took a lot more people to do that. So as the economy continues to sort of morph into more of a knowledge-based economy, my concern is just the income inequality and wealth concentrations. It's not even stabilized. I think it's gonna potentially even accelerate, and that's gonna create pressure for bigger government. It just is. Just like we're seeing the pandemic is creating pressure for bigger government, and they're gonna focus on areas essentials, what government considers essential, whether it's education, healthcare, or housing. And I just think there is a risk in this country of just more public sector involvement in the case of multifamily housing. We're one of the few countries that really even have a market rate apartment industry. So that is a concern based upon sort of direction of the economy today.
I guess it answers the question of whether you're considering international expansion.
Well, I won't say we never looked at it, but you're starting to see, maybe in the UK and Canada, a market rate rental housing sector emerge. But historically, I think even in Canada, Sam would know better than I, but I think they historically refer to multifamily housing as social housing. That says a lot, I guess. But you're starting to see the sector emerge in the UK, but really not across the rest of Europe. We inherited a little bit of a portfolio in Germany from the Arnstone transaction, and our assessment, we both us and EQR moved pretty quickly to get out of it based upon our assessment of that industry in that country.
Tim, let me just shift gears again for a minute. You talked about, the workforce presence, and you talked about, the tremendous transition that we've seen across all kinds of sectors in real estate and elsewhere for, company, white collar, headquarters, and field office workers to have made the transition to work from home. It's obviously a super tough burden on you as the CEO to kind of transition to that remote leadership model. What lessons can you share with us about how that worked and how you've succeeded in keeping the company's team together and focused and productive in this kind of work from home environment?
Yeah, it's a great question, Adam. I'll just say it's worked better than I thought it was going to work. And I think the things that need to get done are getting done. I think the Zoom calls and working remotely, I think it works probably pretty well in a hierarchical structure. I feel like I have a pretty good sense of what my direct reports are working on and where their areas of focus priorities are. They probably feel the same about their direct reports. I feel like there's probably less network effects, if you will, where people feel like they have a better don't have as good of a sense of what might be going on across the enterprise, because we're generally we're communicating a lot within functions or within silos and up and down, but not necessarily all the way across the organization, which in our company, we're multi-market, multi-layered. It's kind of a matrix organizational structure. I'd say it's not the ideal working format to grow and innovate, which is, inherently a collaborative process. And for us, that's a matrix process as well, which just doesn't really work great in this format, in my view. So I think we're getting done the things we have to get done. I think we're maintaining what we need to maintain. In terms of focusing on anything that's strategic and new and different, it's certainly much more of a struggle. So we've been just maniacal about communication, like I'm sure your firm and other companies or people that are on this call are doing, whether it's at the EVP level, whether it's at the leadership level, in some cases talking every day, and broader leadership teams we were talking every week. I can tell you we weren't doing that prior to the pandemic. We were getting everybody on the same call for top 80 people literally every week, probably for the first 3 months of the pandemic. And same within the functional groups, they're probably communicating more than they ever have. But I do think what suffers is that kind of network effect, and just being able to focus on the new stuff or potential new opportunities. So I'll be anxious to get our teams back into the office full time, and we can do that safely.
Absolutely. What about bringing on new people? Have you had some normal level of employee turnover? Is that feasible? How has that worked?
We're doing some. The onboarding's not ideal. Interestingly, they're the newer folks are the ones that tend to show up at the office, because our offices just back up. Most of our offices other than California are open.
Mm-hmm.
We're on a voluntary basis through the end of the year across all our offices. So, and it varies probably from 10% to 30, 40%, depending upon what office we're talking about. But we're doing some interviewing, virtually, and actually hiring and onboarding and doing the best we can. And so it's weird. It's awkward. I'm not sure the new folks are getting the same kind of experience somebody who would have joined the company a year ago. I know they're not. And we're just kind of giving, it's a recession too. We're not hiring as much, and people aren't leaving as much, just kind of given the job market. So turnover is down for sure, but we're trying to do the best we can in terms of onboarding folks.
Let me circle back. You touched on a little bit in terms of the short-term, movement of people to, Vegas and Austin and other places you mentioned. You think in the long term, I mean, you've obviously, as a company, developed a very specific geographic footprint. Other people, Sam Zell, have talked for years, for decades, about the 24-hour cities, and that's certainly the trend that we've seen in the country over the last 20 years at least. Do you think we're going to see a change as a result of all of this, or is it too soon to tell?
Well, first of all, I mentioned before we're about a third of our portfolio is in urban core submarkets, and about 2/3 is suburban infill. Clearly, last decade, the urbanization trend we saw really took hold, particularly in our markets. Urban demand was stronger than suburban demand. That had already started to change before the pandemic. So it's really a function, I think, of demography. If you look at where the leading edge of the millennials are, and affordability, that were starting to drive more economic activity, more folks sort of life location decisions to where they could drive to where they could afford to live. So that was already great. I think this is certainly magnifying and accelerating that. I mean, for obvious reasons, just given the shutdown in most of our urban markets. So I think that was a trend that's just going to continue and maybe just get accelerated. Where if you're somebody who was thinking about moving out of the urban core, in 2 years, maybe you've probably already done that. You've probably already done that today. So I think I think these things tend to go in longer cycles. I don't think we're going back to the urban decay of the 70s. There's been massive investment, and a real renaissance in these urban markets. I think they're going to continue to thrive. I just think the demand's going to be much stronger in the suburbs. And you're already seeing supply shift to address that demand. In the 2010s, the last decade, we saw much more urban supply as a percentage of inventory get delivered, and it started to impact rent growth. That supply is starting to shift to the suburban submarkets now.
Looks like we're exploding with Q&A and chat on the Zoom there. We have Sam back. So Sam, are you going to take us to some of the audience questions?
Yeah, and thanks for everyone who's put questions in. We've got a long list here, Tim. The most popular question is really bottom line, with 10-year treasuries trending below rates that I think folks would have thought possible at any previous time. Certainly below inflation, the Fed's outlook and signaling on interest rates remaining highly accommodative. What do you expect to see happen with the cost of financing, cap rates, pricing for multifamily?
Yeah, that's a great question. As you might guess, transaction markets just shut down the first few months of the pandemic. They're opening back up now, and a lot of it is as a result of what the Fed has done. So there's a lot of product coming to market. A lot of it's getting priced right now, and from everything we can tell, there's been a pretty de minimis impact on asset values. So even though we will see NOI declines, this year and next year, it doesn't seem to have had a big impact on asset values. If you look at the public sector, we've seen a huge impact on asset values. We're down probably 30 to 35%. If you delever that, call it mid 20% range. But from everything we can tell, in terms of the assets that are trading, we're looking at 0 to less than 10% reduction in asset values from pre-COVID levels. And a lot of it's obviously the availability of very, very low cost debt and a very accommodative GSE network as well to help fund that.
Sure. I'm going to turn it over to Scott in a second. Before I do, just a follow-up question on some earlier points you had made. So much of the focus right now, unsurprisingly, is on the federal political dialogue. But for so many of us in real estate, particularly in the multifamily sector, some of the forces at play at the local level require that we're paying close attention there, and certainly some of the local and state level outcomes in November will be determinative of the performance of our portfolios. With whether it's local pushes for rent holidays or more eviction moratoria, in the extreme rent cancellation, which we haven't really seen emerge as an actual phenomenon. Does the confluence of circumstance change how investors might be thinking about the long-term risk profile of investment in the apartment sector? Does it change also, whether it's for you or for lenders, how we're underwriting some of the some of our expectations around growth for income?
Yeah, it's a big question facing the industry right now, Sam. So I'm not surprised there's a lot of even questions from the audience on that. I think if you're an investor in multifamily today, you are viewing viewing regulatory risk differently than you were 5-10 years ago. You just have to. These things tend to go in cycles, and so my view is and has been, because we've seen rent control regimes come in before, they tend to get modified or removed over time as they don't have the intended effect, or as different type of leadership sort of gets voted in. But that doesn't mean you're not going to go through a 5 or 10 year painful period if rent growth is capped at inflation or some percentage of inflation. So I think as an investor, you have to factor that into whether it's your growth or your required return at some level, just the regulatory risk that maybe you wouldn't have, and maybe you should have, but you wouldn't have 5 years ago.
Scott?
Great, thanks. Tim, we saw home ownership rates decreasing for most of the last cycle. There's been a lot of talk in the past 6 months that single family home ownership and even rentals are going the other direction. as a result of some of the containment efforts in urban markets. What are you seeing in the single family space, both ownership and rental?
Yeah, Scott, we're seeing in terms of market-wide, homeownership rates are starting to move up. And obviously, if you're following the news, you know that the housing market generally is pretty strong right now. Maybe some of that demand was sort of pulled forward by the mix of the pandemic, and people that are going to buy 2 years from now are buying today, and a combination of just an accommodative Fed, just given the cost of financing. It was a longer term trend that we saw coming anyway. Just coming back to demography, we have the leading edge of the millennials at 40. 10 years ago they were 30. Today they're 40. You're starting to see the biggest jump from ownership to home ownership traditionally has been that 25 to 35 band, moving to 35 to 45. People are getting married later. They're having kids later. So that increased the renter pool over the last 10 or 15 years. But I think you're going to see balanced growth going forward, and maybe even a little bit stronger towards home ownership over the next 5 or 6 years. You look back at the last 2 decades, they're almost mirror images of themselves. You saw home ownership rates go up dramatically in the 2000s. A lot of that was again driven by what was happening in the housing euphoria days of the mid 2000s. But a lot of that was demography as well. And then the opposite occurred in the 2010s, which was a combination of demographics and just the housing bust that we saw with the GFC. Now, I think if you just look at it just on pure economics and demography, you would expect it to be more balanced, and maybe a bit tilted towards home ownership over the next few years in terms of net demand. Luckily, we went into this downturn really with, if anything, a housing shortage. If you just look at the housing market broadly, for sale, rental, single family, multifamily, so to the extent we get a recovery, in the economy, and I think you're going to see, I think apartment supply will be down. I think we come out of the recovery with a pretty balanced housing market in terms of supply and demand. But that's, it could be 2 or 3 years from now.
Tim, one of the things that we're looking at very closely at our urban lab, which is sort of our center that focuses on city competitiveness, and it's a sort of a point of intersection with the REIT Center, is the way in which cities like New York, Chicago, Detroit, and others are managing very challenging fiscal outlook over the next couple of years. And in a market like New York, where it's not just the city's finances, but also the capacity of adjacent public services to meet the demands and needs of the workforce. So, are we going to see a significant and perhaps draconian reduction in the level of subway service in the city when, people are inclined to prefer lower congestion in any case? When you're looking at the markets to which you have exposure right now, has your weighting, preferences, a sense of risk opportunity when you're looking across markets shifted materially? Are there things going on sort of with local fiscal policy apart from politics that are also figuring into your analysis?
Yeah, no, for sure, Sam. Obviously we got a big part of our portfolios in New York. Big part of it's in the Bay Area. We have both suburban, urban. There's going to be fiscal challenges and potentially regulatory challenges, in both those markets. Having said that, when you sort of step back, you think about the knowledge markets. They still are 2 of the biggest knowledge markets. You think about the shape and the contours of the economy. I think the coastal markets still come out of this winners. However, I do think employers are going to have just much more distributed workforces, and so between the fiscal situation, if you're Google or Apple today, can you really justify growing at the margin, in Menlo Park or Mountain View versus we already know where they're going. They're leaving right now because they have a chance to leave, and so they have a pretty good sense of where the human capital wants to be. And so I think you're going to see workforces be more distributed. And I think whether it's us or our peers, we're going to respond to that ultimately in terms of our geographic footprint. We're going to want to be in those spillover markets as well as places like San Francisco, New York, which I think will continue to thrive. I just don't think they're going to have the share that they had of knowledge workers before. There'll be a lot more knowledge workers. They won't have the same share that they had maybe in the last couple cycles.
Adam?
Tim, one of the questions that we have a lot of students in the audience. And we got one particular question in the chat, but we have a general question, which is, if you were a person, studying at Schack today, starting out, wanted to go into the real estate industry, how would you think about the world? What advice would you give to that person? And one question, which is, a bittersweet sort of a question that was posted in the Q&A here is, if you're a person who wanted to get involved in multifamily development, what would you recommend?
I'll maybe address that second. First of all, I entered the real estate industry in 1987, coming out of grad school. A very different industry than it is today. A much more mature professional industry. You've got the rise of these large platforms, whether they're public or private equity or private development platforms as well. I think there's still room for the entrepreneur in real estate. I don't think the field of opportunity is as great as it was when I came out of business school. What you're looking for is a very entrepreneurial type of experience. So I'll just start with that, because that was something that was a motivator for me coming out in the 80s, was to sort of corner hardware store, sort of through a development prism, if you will. I started in the real estate development world, multifamily apartments, obviously. So I guess my first advice would be, if you want to get into the real estate industry, just recognize that these larger platforms are going to be where a lot of the jobs are, and assuming you want to continue to rise, up through those companies, I think you just got to be very intentional about how you think about career development. When I started, it was very much a small shop generalist type of business model. You learned a little about a lot of things. Now today I look at our organization, we have a lot of people that know a lot more about all those things than I ever did, but they are more specialized. They are a bit more siloed, and to the extent that they want to continue to sort of broaden their skill set, become sort of sharpen their integrated thinking skills. I think they're going to have to be intentional about sort of moving across functions and geographies to sort of round out those skills, whether it's development, asset management, operations, corporate finance, deal finance, where I had to sort of be involved in all those things when I was first starting out in development. So I think sort of the foundation starts with kind of analytical skills and understanding of markets, whether it's capital or real estate markets, deal underwriting. I definitely recommend kind of at least getting sort of that foundation built, and on top of that, you're really focusing on creating peer networks, and hopefully they're role models for you as you come into the industry, that you kind of have a sense of what success looks like, at least in a way that you want it to be defined for yourself. So I do think it's much more mature industry. I mean, we weren't when I started, revenue management, data analytics, IT, digitalization. We weren't talking about any of those things. We're talking about those things all the time right now. So I think you just got to recognize you're coming into an industry that probably looks a lot more like the rest of corporate America in terms of different functions. And if you want to sort of move up the ladder over time, you're probably going to need to be, like you see in other industries, need to be more flexible in terms of what that path might look like, as opposed to saying, I want to be a developer operator, for the next 30 years.
That's great advice. Thanks. It's a little bit early to be talking about this, I think, but nevertheless, thinking forward a little bit, do you anticipate any design or layout changes coming, in the post-COVID world? More work from home space, maybe change in configuration of delivery packages, receiving areas, anything like that?
Yeah, no, it's good question, Scott. I mean, probably, but I think a lot of those were already happening or starting to happen. I think they'll accelerate as a result of this. if you just look at sort of the changing nature of work, a gig economy, people working 24/7, the work from home trend was already gaining traction before the pandemic. It's on steroids now, but so we were already starting to, either in new development or redevelopment, put in co-working spaces, and just trying to create a work environment in terms of whether it's connectivity. I think you'll see a lot more investment in smart home technology, which I think kind of starts with really kind of smart locks and really about remote access. So you can sort of, if you're working from home, just have sort of frictionless movement of goods and services, coming in and out of your apartment or your community. I think these co-working centers are going to have a mix of private spaces and open spaces. They're going to need meeting spaces with equipment like what we're on right now that can really accommodate virtual conferencing meetings. Great connectivity. It's going to need to be community wide, not just within your apartment. So you can move in. You can move from your apartment all the way through the community into the outdoor, even the outdoor spaces, and never lose a connection, which is tough to do today. So I think the work from home movement is definitely a trend that continues. If anything, I think companies are going to be certainly much more receptive to it coming out of the pandemic. Letting whether folks are working full time or part time outside the office.
Great, well, gentlemen, I think that's about all the time we have. Tim, thank you for carving an hour out of your busy schedule to join us today. The members of industry, the students from programs across the country, we all really appreciate your taking the time to chat with us. Adam, let me pass it to you for the formal wrap up.
Tim, really appreciate, as Sam said, your joining us today. It was a great hour. I'm getting a lot of good feedback, and we'll be on replay for the future, and looking forward to the chance to see you again soon in person one of these days.
Yeah, I hope so. Thank you. Thank you, Adam,
so much.
Sam, Scott. Take care.
Thanks. Have a great day, everyone.